Is this
Hello,
a
good
change
morning.
in
Good to see you
thinking
too.
by investors overall, or is this ultimately a market structure story, what's happening right now?
I didn't hear the first part of your question. So which market structure are you referring to?
I'm talking about the way that we have this information we digested, and is there a change in sentiment, i.e. what is being priced in now when it comes to bonds and indeed what's going on with equities too?
Well, I think the Fitch downgrade yesterday was, and it was sort of building up a little bit of a risk-off sentiment in recent days, but the trigger was perhaps offered by the Fitch downgrade, which was somewhat unexpected. I mean, I wouldn't read too much into it. I think we had a very good run in the first half of the year, led by, initially a dozen, certainly not more than a dozen stocks. And I think now it's due for a pause because investors realize that, there's still issues out there that aren't completely unresolved. And the Fitch downgrade was actually a good reminder. That said, I don't think we have a major regime change. I think this too shall pass.
So, Mikio, what happens next? That's the point. I'm just looking at the US now in particular. It seems that the narrative is changing not to when will interest rates peak, but more towards how long will the interest rates remain high and what will be the impact on growth. Everybody is seemingly a little bit Pollyanna about it. Is this a bit of complacency?
Yes, indeed. I think that is the uncertainty, the main uncertainty that is out there. I mean, now we know that the Fed is likely to, at the very least, pause at their next meeting. Then it will really depend. It's really, we just have to wait and see. Now, we are in the camp that we are rather afraid that afraid is perhaps not the right word, but, the U.S. economy is actually doing pretty well. You have tight labor markets, so low unemployment feeding into continued income growth, and that's fueling consumption. So we think that inflation will actually stay stubbornly high, so the Fed might actually resume interest rate hikes later down the year, even if we avoid a hard landing, which is the base case right now. So looking into next year, there is still a lot of question marks about the magnitude, the impact of the rate increases that we saw so far. And there are risk from, in our view at least, is that the Fed might surprise on the tight side.
Right. Mikio, David here. So interestingly enough, in one of your calls is not to really throw reason out the window, but you have a call here on being reason agnostic on the yield curve. What does that mean?
Well, right now, so we thought if you look at the yield curve in from a longer term perspective, it's very inverted, talking about the 10-2 year in the US specifically. It did a sort of double bottom, triple bottom in a technical perspective. So historically, somewhere around these levels, we think it's without, of course, understanding that we're not able to exactly time the market, but we think it's a good time to take a steep enough positioning. And we got the agnostic view was confirmed yesterday. We got this unexpected Fitch downgrade. The yield curve did actually steepen in response. So that is one of the many things that can drive a yield curve higher from here. The reason is not the one we particularly expected. We thought more it's going to come from the monetary policy side, but we're happy that it's in line with our view on that specific part of the segment of the markets.